Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. Our show today is brought to you by CommercialAgentSuccess.com. Check it out. It's 21 one-hour videos. It is incredible training for commercial agents. Learn more at CommercialAgentSuccess.com. Well, Commercial Real Estate Show, America's Commercial Real Estate Show. What do we want to know? We want to know what's going on. What should we expect moving forward? I have questions. We're going to get you some answers. Please welcome my guest. It's Ryan Severino. He's Chief Economist with BGO. Ryan, it's so good to see you in Studio One.
It's nice to be back, Michael. Thanks for having me. It's always good to see you.
And, you know, for you guys and ladies that have been loyal listeners to the show for many years, you've heard Ryan on the show for, wow, how many years?
It's got to be 12, 13 years at this point, which just makes me feel old when I think about it.
Yeah. Well, that's great. It's good to have you back. And as I mentioned, I think we all have a lot of questions, you know, with what's going on in the commercial real estate world, with the debt, with capital markets, with the politics angle, and now we have, you know, more insurance worries. I suspect with the poor things that happen in California. But let's start with this. You know, the 10-year Treasury has really been escalating while the Fed's been lowering rates.
Right.
It's had a bad impact on mortgage rates for real estate. What's going on?
Yeah, it doesn't seem like it makes a lot of sense, right? That the Fed could cut 100 basis points between September and December, and yet, you know, the 10 years now run up 120-ish basis points last time I checked from where it was about the time that they started cutting. It doesn't make a lot of sense to me in a particular way. On the one hand, I get that the bond market is not happy about certain things. It's not happy about the Fed rolling back its forecast for rate cuts a little bit. It's not happy about what it thinks could be some inflationary policies coming out of the incoming administration. But something about the mathematics feels off to me, because if you think about the environment when inflation hit multi-decade highs in mid-2022, you know, CPI was north of 9%. The 10-year barely touched 5% then. So for now to be within shouting distance of 5%, when inflation is within shouting distance of the Fed target at 2%, you have to make a lot of assumptions, or you have to feel really uncomfortable about what you think could happen this year. And so my sense is, between the market not liking what the Fed has done and how the Fed's kind of mismanaged its rate cuts a little bit and its forward guidance a little bit, and its lack of transparency and clarity on what it thinks policy decisions are going to be, it's almost kind of assuming, if not a worst case scenario, a really bad case scenario, and it's adjusting to that. Whereas I don't think that's going to be the case. I think there is clearly room for some poor policy decisions, just to be honest about it. But to get to that kind of negative environment where a 5 handle on the 10-year feels appropriate to me, we'd have to see a lot of things go off the rails to get there. So this feels like the Treasury market throwing its toys a little bit, overreacting to some things that I think are a little easier to understand, and some things that are probably a little more difficult for the market to understand.
Yeah, and you mentioned policy. And so one of the things that seems to be making some people nervous are the tariffs, and the talk of Trump's about tariffs. Is this negotiation on his part? I know you're not a political analyst, you're a real estate economist, but what do you think happens there in this impact?
Yeah, I mean, just thinking about it, you know, probability wise, it would be something if we really went the full on internecine trade war route, because there's a lot of ground between I just want to rattle my saber and scare anybody, and I really think that we should start this race to the bottom trade disaster. And if you look at the last 8 years of administrations, both the first, you know, Trump term and the last 4 years of the Biden administration, we have implemented some of those policies. Some of them the Trump administration put in place, the Biden administration left in place, some of which were additions on the part of the Biden administration. And we didn't implode the US and global economy in the process. So I think undoubtedly some of this is a negotiating tactic. And I don't doubt that they would probably like to put some wins on the board and say, hey, look, we did some of this stuff without having to go the full, DEFCON 1 route where it creates a lot of collateral damage in the economy. So I think some of this is a negotiating tactic. I wouldn't be surprised if we got some additional policies out of this, but to go immediately to the nth degree with this, that feels not only presumptuous, but really like an overreaction to me, because there's a lot of ground between, like I said, rattling your saber and let's destroy the global economy just because we want to make a point about something.
Right, and our audience is a real estate audience, right? And all of us negotiate for a living. Trump is a big negotiator. He wrote a book on negotiation, right? So I guess you do want to start at a position of power in a negotiation, right?
And if you want to use his last administration as a benchmark for this, I think there are some things in there that you could probably, take some information from. Like, again, I'm not a political person, so I don't mean this as a political statement, but like a wall wasn't really built, right? Like on the southern border. Like I'm pretty sure there are, outfields and stadiums in Major League Baseball that are, as long as some of the sections of wall that got built or repaired. But it was enough that they could put a win on the board and say, look, we did some of this stuff without building, this really defensive position across the entirety of the southern border. That's the kind of thing where you can put a political win on the board. You can probably do one or two things here and there, but you don't have to go all the way to the nth degree with this. And like I said, cause a lot of collateral damage in the process.
Yeah. We're talking with Ryan Severino. And one of the questions I think my audience is curious about is what might the Fed really do moving forward? Where were you on inflation? Your thoughts?
I still think they have to move. I think the Fed understands that even with cutting 100 basis points since September, that real interest rates are positive, even at the short end of the curve, right? You cut 100 basis points, we're down in, I'll use the range, kind of the mid 4s to high 4s range. If inflation is pick your favorite inflation index, mid to high 2s, even into the 3s, then real interest rates are positive to the tune of 100 to 200 basis points. And that is pretty restrictive to economic activity. And the Fed knows this, and they have so much as acknowledged it. They can leave real interest rates there for a while, especially as they bring it down, but not indefinitely. And there's some tentative signs that maybe the underpinning currents in the labor market are let's just say they're not as strong as they were 12 months ago or 24 months ago. So they're constantly in this balancing game between we're trying to manage the economy to full employment, but we're also trying to manage the price stability. They know they have to cut. We'll probably get a couple more this year. But I don't think they want to do nothing, even with some concerns about, potentially resurgent inflation. I think there's a lot of misunderstanding about inflation. I think there's actually, some mismeasurement of inflation that's going on in the U.S. I don't know if we need to beat that dead horse on the show again, but I think one way or another, they would like to keep bringing rates down because they know they're too restrictive, even if they had to walk back their last forecast and not be as aggressive as they thought they once might be able to be. Because I think they understand that there is a risk that if they don't do anything on rates and they leave them where they are for a while, it increases the probability of starting to cause some more widespread damage in the economy and the labor market. And I think they would ideally like to avoid that if they can. And there is a space there. There is a space between do nothing and, cut rates to zero, where they can start to bring rates down in a managed fashion without really running much of a risk of reigniting inflation or contributing to some kind of reinflationary process.
And I guess the Fed, do they not take in the impact of the impact on banks or the interest on the federal debt?
They'll probably tell you that they don't because they're really focused on their mandate. But, they're people. They're human beings. They have to be thinking about this to some extent. And I think they understand that raising rates as aggressively as they did in such a short period of time did produce a lot of fallout in the, our industry is exhibit A for that, right? Not so much in housing because there's such a shortage of housing that you could almost, do anything and not shock the housing market that much these days. But in commercial real estate, where a lot of the assets return still comes from income, it's incredibly interest rate sensitive. And so if there's any industry that should be, crying and throwing our toys. It, should be us given what's happened to us in the last few years.
And maybe the banks.
Yeah. And the banks to a certain extent too, no doubt about it.
Well, speaking of banks, what do you think about transaction volume trends into the next year and the capital markets and financing?
I think this is really the crux of the matter for us in this industry. That if you look at the space market fundamentals, they've, outside of office and parts of office, they've held up pretty well. Mm-hmm. For me, this is the part of our industry that has really taken it on the chin over the last few years with the Fed raising rates. But if you look at how the commercial real estate market behaves, and I know I'm telling you things you already know, it tends to follow relatively long and pronounced cycles. It's not idiosyncratic. It's not a random walk the way, say, the equity markets are. Mm-hmm. When you see things start to turn, you get to a turning point, you get to a stabilization point, and then you get a reversal. Mm-hmm. We've really seen enough of the data at this point that leads me to think that we're even past that turning point. Volume is kind of stabilized, so we haven't really seen a run up in volume just yet. But we've seen returns across the industry swing from negative to positive over the last year, which is a big indicator, because we've seen valuations stabilize and in some cases start, maybe not necessarily start to go up again, but they're not decreasing at the rate they once were. And even on the cap rate side, we've been looking at, I'd say enough deals over the last, 12, 18 months or so where pricing has started to move a little bit. And so enough of those variables are all generally moving in the right direction that leads me to think, unless we get some kind of shock, right? Something random or some kind of policy mistake, there's no reason to think that we shouldn't continue to get better metrics out of the transaction market. So what does that look like? Somewhat higher volumes, I think, somewhat more active debt markets. Although to be fair, it does seem like objectively the debt markets have been more active over the last 3-4 quarters than they've been in some time. Better returns, appreciation swinging, just from being less negative to being positive. And I think actually real cap rate compression over the next 3-4 quarters. So if we can avoid those kind of shocks or policy mistakes, I don't think there's any reason why that pronounced cyclicality that we see in the commercial real estate markets shouldn't materialize this cycle. There's nothing that's happened over the last 4 to 5 years that leads me to think something fundamental has been broken about the way the real estate market behaves, and we need to not look at that as a true turning point in the market. Yeah.
Well, on the brokerage side, we are seeing an increase in volume, as far as sellers willing to take things to market and more buyer activity on our assignment. So it's encouraging, because it has been discouraging for a few years, right? For that rapid increase in the rates. So it's been a mess. And you mentioned fundamentals and occupancy, and let's talk about office, because that's the one that's been hurt the most. Of course, there's a lot of office doing really well. Right. The newer properties, the Class A, the ones with a lot of amenities, medical office, and even government office seem to be doing really well so far in this market. And then we're seeing a lot of headlines, right? With big companies, hey, bring our people back, right?
I think there is a far more nuanced story than a lot of what those incendiary headlines would lead you to believe. And I know you and I have talked about this a little bit over the years, but it reminds me in some respects of how people had written off retail once upon a time, right? Very broad brush, same kind of thing, e-commerce, retail apocalypse, mobile bank, mobile commerce, all that stuff. And I thought, well, you're kind of generalizing a little bit from a very broad inventory base. And I feel as if the same thing is happening now, because you're right. There are some parts of the market that are thriving. And I think as more organizations call their employees back, they're realizing that maybe their footprint doesn't actually match up with the size of their workforces ideally as they would like it to be. And there are not a lot of good contiguous blocks of space to be found either in those Class A buildings, or even, where our office is on Park Avenue in New York, aside from, the JP Morgan building that's going to get finished, relatively soon. It's not as if a lot of those buildings, are brand spanking new, that they were, they've been there for a while, and yet there's not a lot of vacancy on that corridor. So if you're really well located, or you have a really compelling asset, it's not a lot of vacancy to go around. And I think the more that the market adjust to this, because we're still not fully at equilibrium. We went through a very significant shock, and it takes years for those shocks to stop reverberating. But I don't want to go so far to say is, there's a price for everything, because you have to be careful about some of the inventory. Yeah. But I think it's a massive mistake to throw the baby out with the bathwater here. And it just goes to show you sometimes how we have such short-term memories in this industry. We did it a little more than a decade ago with retail, and it was a monumental mistake then. I think a lot of people are probably going to make the same mistake about office. I'm not saying it's going to be amazing tomorrow or in 24 months. But I don't think we're going to wake up in a world, 10, 20, 30 years where offices just are not a functional part of the economy. That doesn't feel right to me at all. Yeah, I'm with you there. Another example, I guess, is housing during the recession, right? No one wanted a house. They were all getting foreclosed on. Right? I'm laughing because, again, like you and I have been doing this a long time, more than a decade. I've been doing public speaking about the economy and real estate for, again, I'm going to feel old, but it's more than 20 years or so at this point. Last cycle, coming out of the GFC, I can't tell you how many times I tried to warn people, right? Because there was this popular, narrative out there about like, oh, millennials, they're so different. They don't want to own anything. They're going to rent, their apartments in urban areas and take their bicycles and public transportation to their green open plan offices, where they're going to hold hands and sing Kumbaya or whatever they're doing. And I'm like, you guys, you were not getting this right. Like, you were mistaking a temporary disruption to how the real estate market is functioning and how the mortgage market is functioning for some kind of structural change. And so I would literally get booed at some conferences where I tried to tell people this. Wow. Like, so many people would come up to me and they'd say something like, oh, my son and his friends, blah, blah, blah. They don't ever want to own a house. And like, I'm not trying to strain my arm, patting myself on the back, but look where we are now. Like, we are in a, 4 or 5 million unit housing shortage. And so I think people in our industry need to be careful about just wholesale writing off a property type or a large segment of the market, because not only is that too broad, but these are not permanent conditions, right? At some point, like, the thing I really love about economics, even in real estate, is that we'll figure stuff out, right? If we have too much supply, we'll figure out what to do with that. If we have too much demand, we'll figure out what to do with that. If we don't have the right supply or it's not in the right places, we will figure out what to do with that. People just are not great at planning and thinking about the future. And I'm not saying I have a perfect crystal ball, I'm clairvoyant or anything, but I've been around the block enough to know that this is not a permanent condition and it will change at some point. And so be careful about taking the current environment and extrapolating from that indefinitely. I don't know exactly where the office market's going to be 5-10 years down the road, but I can tell you almost with 100% certainty, it is not going to be in the place that it is today. Yeah, well, good point. And when non-real estate people ask me about the market, and they go, oh, you're Michael Bull, tell us about it. I tell them, look, if you're at a cocktail party and everyone's talking about real estate is doing great, it's doing fantastic, we're flipping contracts and stuff, you should be selling. And if everyone at the cocktail party is talking about how terrible things are, real estate's dead, whatever sector they're talking about, you should be buying. I've been doing this again a long enough time. The people I know in this business, all kidding aside, the people I know in this business who have been the most successful are the ones who are not afraid to be contrarians. And I'm you know me long enough. I'm not afraid to be a contrarian. I'll speak my mind. And I think like them, I don't do that to be transgressive or subversive, but I look at something and I think, boy, if too many people are so sold on something, there's probably something that people are missing about this. And maybe I need to think a little more critically about that. Your point about a party people talking about something. I knew we were in trouble in the housing market in the 2000s. I was speaking at an event. I'll never forget this. It was September of 2006. And I was speaking at an event in Las Vegas, and I'm taking a cab back to the airport, and the cab driver asked, oh, what were you here for? And I said, oh, I'm here for a real estate conference. And the cab driver said, real estate? I own 7 condos. I remember I was working at Starwood Capital at the time when I got back to the office. I said, guys, we need to talk about this, because like, I couldn't believe that I heard, and that's not I'm not a pejorative. I'm not taking a shot at cab drivers. I was just really surprised that someone like that told me that they own 7 condos in Las Vegas. That just the math didn't make sense to me then. Oh yeah. Well, my sister during that time, ends up owning 4 beautiful
huge beach houses. And I'm like, that's not a good move. That there's no history of income on that. Well, they're going up in value this much. You're speculating.
Yeah, just what you could do, just be prepared to take the risk if that doesn't go according to plan.
Yeah, and it didn't.
No, I'm not laughing at your sister. Just like I feel like that is a fairly familiar story. To your point, like if everybody is, it's the fear versus greed thing. People are always worried about missing out on. They're always fearful of something. They're either fearful about missing out on something, or they're fearful about the sort of the proverbial blood in the streets sort of thing.
Well, some of my listeners have heard me say this before, but I predict that the office will be, when we look back at this decade, that office will be the big win that people kind of bought when it was really at the bottom, and it's going to be the windfall, because I think some of these buildings will get torn down. We just looked at one last week, and we told them, tear this one down.
Right.
So we'll sell it for land, and then some will get converted. And then some will get renovated and done nice, right? And then you'll have the overall growth of the office, users, the population and job growth, right? And then you'll have new supply that kind of slows down to a trickle. So I think you put all that together, give it some time, and I think that it is the contrarian buy of this decade.
Yeah, I agree with you. I think people really have to do their homework on this. It won't be easy. But if you think about fundamentally what happened, we went through a demand shock, right? We had the pandemic, and we're still readjusting to that. And as I said before, that takes time. When you go through that kind of demand shock and demand decreases structurally, irrespective of where it settles, right? I think it's fair to say demand is effectively lower relative to where it was before the pandemic. Sure. Well, then you need the supply side to adjust. And in real estate, it doesn't adjust overnight. It takes time. We will undoubtedly go through that, right? Again, the real estate market always goes through that. And to something I was saying before about where we'll be in 5, 10, 15 years, unless you think, again, that we're just never going to work in offices, as the economy continues to expand, the labor market will continue to expand. A lot of the jobs that get created because of where the U.S. is in our economic evolution will be what we traditionally thought of as office-using employment, information, technology, financial services, business professional, things like that. That suggests to me that once the shock of this stops reverberating, we expand the economy, we keep hiring people, demand will start to push out again. And then supply will have to adjust to keep up with that. Again, that's a multi-year adjustment process, but it will happen. Ultimately, it will happen. And whoever figures that out the best, I think you're right. I think we'll do incredibly well by this property type. Yeah,
I agree. And I kind of left that part of my scenario out on why office rebounds is the increased demand from the back to work, that a lot of these companies are doing. They're figuring it out. And I think one of the things that will get folks back to work is cybersecurity. Imagine trying to keep your information secure when your employees are using it wherever. And also you don't know who's looking at the screen. I just think there's a lot of reasons that that demand comes back. Well, let's move on. And one of those items that will create more demand is employment and jobs. What do you expect there moving forward?
I'm still cautiously optimistic about the jobs market. I think the one thing that is an interesting headwind is just we are still dealing with a labor shortage. It's a very structural demographics-based labor shortage. And it's not the only reason that job growth has slowed down, but it was in the initial stages of job growth slowing down from that very, kind of, I don't want to say overheated period, but that really hot period, 2022, even into 23 a little bit. We just eventually start running out of people. Now, I'm not saying everybody has a job, and I'm not saying everybody has their dream job necessarily, but there's still a lot more demand for labor than supply. The white collar part of the labor market is going through a bit of a kind of stasis right now. There's not a lot going on, but to me, that's more of a short-term phenomenon than a long-term phenomenon. Because again, unless you think the economy is going to stop expanding, then the size of the labor market will have to increase. The number of people working will have to increase. I'm still cautiously optimistic about labor. I do think we need to be a little bit careful right now, almost going back to what I was saying about the Fed before and rates, because the hiring rate has slowed down considerably over the last 2 years. And it's now about where it was let's call it a decade or so, probably around the same time you and I started doing this in studio, where the hiring rate has slowed considerably. I've heard people call this labor market the don't hire, don't fire labor market, because demand isn't just this deluge of demand where everybody's getting hired, but also people aren't really getting laid off that much either. And that can keep the labor market tight. But if rates do stay too high for too long, then I worry about layoffs maybe ticking up a little bit more than they have, especially in the more interest rate sensitive parts of the economy, construction, manufacturing, things like that. We're not there yet. And I do think that we're at a very strong position because labor supply is so scarce. But I do worry a little bit that the labor market, if the Fed gets this wrong, could be some of that collateral damage. But for right now, it's hard to classify the labor market as anything other than tight. You might not say it's super healthy if you're out job hunting, which I readily understand. But by and large, you look at where equilibrium is, 4.1% unemployment rate, wage growth, well in excess of inflation at this point. So employees are taking home, actual real wage growth. It's hard not to see that as being a fairly robust labor market right now.
Yeah. One of my clients I was just talking to before we do the show today is concerned about deportation, and he feels like he's going to lose a lot of his labor. I'm like, well, where are you getting their labor? Are these guys criminals? No, I didn't say that to him. I mean, I know that's not the case. But what do you think the impact could be on the economy and real estate of Trump's plans to the deportation?
This is almost similar to the tariff question, right? There's a lot of ground between doing nothing and some of the political speech that gets thrown around during a campaign. I think just objectively, it's probably harder to go to the extreme, 10, 12, 15 million people, however many you think, not just because of the logistics of that in terms of, do you have the infrastructure in place, and would you have states and municipalities cooperating with you? But that's expensive. The estimates that I've seen for that are in the hundreds of billions of dollars. The entire Justice Department budget is $60-70 billion. So are they going to appropriate, new funds to pay for that? Not if they're really worried about keeping a lid, at least to the extent that they pay lip service to this, keeping a lid on expenses, or that, the Doge team going out and trying to actually, cut some spending. That doesn't seem that likely to me. So it seems like there's that gray area that you could play in where you can probably, deport some criminals or, new entrants, people like that, and put a political win on the board without having to go all the way to the nth degree and then just deport 11, 12 million people, because those workers are concentrated in certain industries in the economy. And I don't think it would be massively inflationary, because you would not only lose labor supply, but you'd also lose demand for a lot of goods and services, and a lot of the workers you're talking about just objectively, again, not a pejorative, aren't making that much money to begin with, and would probably incentivize a bunch of organizations to go out and invest even more in technology than they have today, which also tends to keep a lid on, or at least help to keep inflation from accelerating. But in certain industries, like, it could be very disruptive. In agriculture and farming, it could be disruptive depending upon how many people get deported. In construction, an industry that we care a lot about, it could be disruptive depending upon how many people get deported and where they're located, because it's not uniform across states. The concentration in places, Florida, Texas, California, even, where I'm from in New Jersey, it's not as if the immigration population, including the illegal immigrant population, is uniformly distributed across the country. So it would be more of a locally concentrated phenomenon, its impact, than I think some of the headlines, which are just saying like, oh, it'd be so inflationary. I'm like, well, yeah, but probably concentrated in particular, goods, services, and probably more so in certain parts of the country than other parts of the country. But I think there are ways that this can be done, that, again, you can put a political win on the board if that's really what you want to do, without having to be massively disruptive at the same time.
And this is a commercial real estate show, so I think it's fair to ask you about your thoughts on AI, right? Because we got these big data centers, and that's a big push in real estate these days. But we also have, electricity needs there, and a lot of push for electric vehicles. Somebody was telling me, was it you? Somebody was telling me they thought we might be 2 years away from rationing electricity. What are your thoughts on AI and electricity and that impact on the economy and real estate?
Yeah, I don't think the average person appreciates just how much greater the energy consumption is from this technology. Just to give an example, I'm going to get the metrics a bit wrong, but I'll be in the ballpark on this. One chat GPT query uses something like 10 times the electricity that a Google search does because it just has to do so many more calculations in order to do that. And I say this, just putting our cards on the table as an organization that is developing, data centers and investing them, here, Europe. We haven't done it really in Asia yet, but I wouldn't be against that idea personally. The electricity part of this, the energy part of it, is a significant constraint because these are significant consumers of energy. I mean, I was reading an article, I think it was in the Journal last week, about how down here in Atlanta, there's more pushback on development of these centers than there's been in the last, 5 years or so. And some of that's because the consumption now in these centers these aren't the data centers of 10 years ago where it was mostly, cloud and storage. Now you have hundreds, thousands of these GPUs running simultaneously that are doing these calculations that just require massive amounts of energy. I think that is going to be the significant barrier to a lot of the development. And maybe it causes us, rationing sounds like a scary word to people, but maybe what it does, thinking through the lens of economics, is it forces us to really think and prioritize what uses of this are the highest and the best. And those are the ones that generate the most value add in the economy. And therefore, those are the ones who are willing to pay for the energy or figure out ways to develop it, on site for themselves or adjacent to some kind of, cogeneration plant. Yeah. But at the rate that we're going, these things consume so much more energy than your average, warehouse distribution facility or even your average, office or multifamily building in ways that are, I think people who are not familiar with them maybe can't fully appreciate just how much energy consumption really goes on there. And I will just simply say this, in the short to medium term, it seems like the demand for that energy is growing a lot faster than supply is, right? We haven't really built a lot of nuclear. I'm not a champion or a critic of nuclear power per se, but we haven't really built a lot of nuclear over the last few decades in the United States. We've been trying to take some of the the dirtier kind of coal plants offline. We've sort of been trying to figure out, can we replace that with natural gas? But either way, we haven't had the kinds of addition to power generation nearly along the lines of the additions to power demand that we're likely to see from these. And at some point, the math is just not going to work. And so we're either going to have to, again, rationing is a word that, I don't know, harkens back to World War II or something like that. People aren't crazy about that expression, but it doesn't seem like we can just, on an unfettered basis, let this keep going because there just isn't enough energy to go around for what I think, ideally people might like to develop.
There's headwinds and there's also tailwinds, right? And when you think about Trump, what about oil and his thoughts on the pipeline and things? How might that impact the economy and inflation?
I don't know if it has that much of an impact. Like, I think the average person maybe doesn't appreciate how we are already the world's largest oil producer, that we're already, it's interesting to me because I grew up in that era where, oil was such a rare, precious thing. And because energy production, at least once upon a time, peaked in the US in the early 1970s. And it went down until, the big major energy companies started investing in capacity. I remember, you probably remember this, but you get to the late 90s when we had excess capacity and, gasoline was less than $1 per gallon in the United States. It sounds kind of, quaint to talk about that now. I think the big constraint on doing more of that kind of energy development is Wall Street, honestly, because after the shale boom and bust, a lot of those small companies ended up selling and it became more institutionalized and Wall Street became such a bigger player there. Don't quote me on this, but the break-even point that I've heard is somewhere around $79, $80 per barrel. Above that, they'll start drilling new wells and they'll still pull stuff out of the ground. Below that, they don't think the math makes a lot of sense. And so I think we'll continue to expand production as the economy grows. I think we'll continue to develop other sources. But to me, Wall Street is the thing that's really added that level of discipline to the exploration side of this business more than anything else. And again, I don't think the average person probably appreciates that the United States is now, the energy superpower of the world, at least, that kind of energy. And if for some reason we did get some kind of spike in energy prices above that threshold on a more permanent basis, say what you want about Wall Street, like those guys and gals like making money, like they would give them the green light to go ahead and start drilling more wells. So to me, I think that's the part of this equation that probably doesn't get appreciated as much, how, for lack of a better term, how institutional, the shale industry's gotten relative to where it was in, 2015, 2016, when it, they over drilled and the oil price crashed the last time down to whatever it was, 20 something, 30 something dollars per barrel.
Well, correct me on this. Didn't Biden get into action and kind of shut down some of the pipeline stuff? And didn't that cause an increase in gasoline prices? And if Trump gets in and opens some of that back up and gets some of that rolling, would it really have no impact? Do you not foresee any chance that oil prices or gas prices could come down any?
I think it kind of depends on the profitability for these firms. And so just because he says, okay, do more, again, like there are a lot of wells that are just kind of idle that have that were drilled in, the last 5-10 years that aren't pumping right now because like economically it doesn't make sense. So I'm not so sure we need to go drill a bunch more as opposed to does the economics of pulling this out of the ground make sense right now? Yeah. Again, like say what you want about Wall Street. If they thought they were going to make money out of this, they would absolutely give them the green light to go ahead. The fact that they're not doing that suggests to me that they know something about. And again, like I'm looking at this from the outside, I would never profess to be an energy economist, but the fact that Wall Street is not giving them the green light to go ahead, even at, wherever we are these days, $60, $70 a barrel, probably suggests that they don't think it's profitable and they'd rather not invest the money in it. All right.
Let's leave with this, Ryan. What do you think are some potential opportunities in our industry moving forward?
I'm still pretty optimistic, even, given some of the risk that's out there. I think retail, going back to something that we said before, is underappreciated. I think too many people are still reading negative headlines I'm not anti the press. I'm friends with the press. The press is certainly my ally at times. So I'm not trying to make it sound like I'm against the press, but scary headlines are out there. And a lot of people that I talk to still think that there's this Armageddon in retail. I think that's not the case. And I think slowly people are recognizing that. And you've started to see it in not just in the fundamentals, but also in the returns are really starting to turn around. I think retail has a really good chance to be the best performing asset class from total returns over the next, 3, 4, 5 years. Multifamily's taken it a little bit in terms of financing because I think there were a lot of people that went out and bought some multifamily projects with short-term floating rate financing, and that's been a struggle for them. But we are still significantly undersupplied on housing in the U.S. And just because maybe we've overbuilt in the Class A segment of the market in certain metros across the country doesn't mean that fixes our national housing shortage. And even there, the pipeline is really starting to close up quickly. And so I think, to me, that's the property type that has the potential to swing from being out of favor to more in favor the fastest, because it's really just this. The financing side will change because I think, as we were saying before, the Fed will keep raising rates. The pipeline is really already starting to dry up. You give it another few quarters, and don't quote me on this, but again, I think it's the major property type where that changeover from being out of favor to in favor might happen a lot more significantly and quickly than the average person perceives it. And then lastly, like I'm still a believer in, again, I like data centers. I like what I'll broadly call industrial. And by industrial, I don't just mean warehouse distribution, although I still like warehouse distribution. The stuff that's a little more technical, a little thornier, for lack of a better term. Cold storage, I still really like because we're massively undersupplied on that. And a lot of the inventory is old. And if it's not functionally obsolete, it's not the most efficient. And so some of the new centers are in a much stronger position. Again, like they're bumps in the road with what's happened over the last few years, but I still think that part of the industry is only going to become a more important part of the economy. I think warehouse distribution becomes a more prominent part of the economy over the next 5-10 years, especially as we continue to increase electronics and automation and things like that. I think the cold storage and the cold chain distribution system starts to become a more prominent part of that. And so I think there are more opportunities out there than I think there are pitfalls out there. If there's anything I'd say to be careful about, it might just be in those segments of the market like office, where right now it can be a little bit different. To your point, right? Some buildings need to be knocked down, some and just sold as land. Some need to be converted. Some need to be CapExed and turned into a higher quality property. And takes a lot of studying and homework to get that right. And that's where I'd say just be a little careful. But even there, I think there are probably unpolished gems for people to go out and find. So I think at this stage of the cycle, there are significantly more opportunities to be had than there are risks. And that honestly, that's a nice position to be in, because I'd say over the last 2.5 years, we've found ourselves on the other side of that coin, where with the Fed raising rates aggressively in a short period of time, there were a lot of things I think people felt like was a good opportunity that probably turned out to be a little bit of fool's gold. I think we might be seeing the reverse of that now, where people are perceiving things as being potentially a little too precarious, when the reality is things might actually start improving in a way that people aren't expecting right now.
Yeah, that's a good point. Had someone say to me a few weeks ago, date the rate, marry the deal. Right. and I thought about that, think about, well, commercial real estate is typically a long-term hold. The rates are today. Right. And I own some properties that I bought when interest rates were high. It doesn't really matter now what those rates were. It was a good investment.
I've even said something, similar internally. I didn't quite use that kind of, that's a great expression. Mm-hmm. But the way I think about it is, if the deal makes sense today and the financing part of the market is not so great, the financing part of the market will change. It's inevitable, right? This is a cyclical phenomenon. That deal's not going to be there forever, and that pricing isn't going to be there forever. So if that is a deal that makes a lot of sense, that you could potentially see yourself holding for, we have relatively long holding periods in this industry anyway, then you buy the deal because it's a good, compelling thesis. And then even if you have to wait a little bit, then you figure out the financing a little bit farther down the road. And that's something that I think a lot of people in this industry are hesitant to do. I don't think that they particularly like thinking about things that way. I think they like thinking about things in a very concurrent fashion. You buy the deal and you think about the capital structure at the same time. Capital structure is not, an immovable object. You could certainly adjust that over time. But if that deal's gone, right, ownership is fairly mutually exclusive in real estate. It's not coming back to the market. And once that pricing moves, going back to the cyclicality that I was discussing before, that tends to move in a relatively long, pronounced cycle until it peaks and turns again. And that's not going to happen tomorrow or 6 months and 12 months. If the momentum can be sustained, we could be in for a pretty good run for not just 12, 24 months, but potentially into the latter half of this decade. And that's why I think if you see a deal that you like, you probably do want to marry it, because that deal's not going to be around for too long if it's a really good deal, and the pricing on that I don't think is going to last beyond once the Treasury market figures out that we're not headed for complete doom and gloom over the next 3, 4, 5 years. Right.
Well, good point, Ryan. As usual, great information, sir. Thank you for joining us.
No, thanks for having me. I always appreciate coming in and being in studio. It's always my pleasure.
Yeah, it's great. Thank you for being here, and thank you, audience, for being here. And let us know what you think. Appreciate you watching. Appreciate you listening. Appreciate your sharing. Hey, if you have any questions, you have any ideas or thoughts for me, reach out to me. My email is an easy one. It's michael@bullrealty.com. Until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty, commercial real estate sales, leasing, and advisory services. Visit bullrealty.com or reach out to me directly. My email is michael@bullrealty.com. By ShareFile, designed with real estate and other highly regulated industries in mind, ShareFile offers secure digital solution to simplify workflow and improve collaboration. Visit sharefile.com. By Commercial Agent Success Strategies, 21 cloud-accessed agent training videos. Learn more at commercialagentsuccess.com.
You're invited to subscribe to the show wherever you listen or watch the show. You're also invited to subscribe to a weekly email announcing the show topic and guests at creshow.com. Thank you for watching, listening, and sharing America's Commercial Real Estate Show.